Folks, let's talk about the stock market, that magical realm where money mysteriously appears and disappears faster than a politician's promise during an election year. It's a place where fortunes are made and lost in the blink of an eye, and where the line between genius and madness is often blurred. It's the ultimate game of chance, except you don't get free drinks and the occasional encouraging pat on the back from a seasoned pit boss. Instead, you're left to navigate the treacherous waters of financial speculation on your own, with nothing but your wits and a few questionable stock tips from your cousin's friend's barber. Instead, you get confusing charts, cryptic financial news, and that nagging feeling in your gut that you have absolutely no idea what you're doing. It's like trying to read tea leaves. But the tea leaves are written in a language you don't understand, and the tea is actually a highly volatile commodity. But hey, that's part of the fun, right? The thrill of the unknown, the excitement of the chase, the camaraderie of fellow investors all trying to outsmart the market. It's like a high-stakes game of Monopoly, but with real money and real consequences. Who needs the thrill of skydiving when you can experience the heart-stopping rush of watching your retirement savings plummet faster than a lead balloon full of bad investment advice? It's a roller coaster ride of emotions, from the dizzying highs of a bull market to the gut-wrenching lows of a bear market. The stock market is like that friend who's a blast at parties, but also has a bad habit of borrowing money and forgetting to pay you back. You love the good times, but you can't help but feel a little wary every time they come around. Sure, there are good times, times when the music's pumping and the profits are flowing. Those are the moments when you feel like a financial genius, when every trade is a winner and every investment pays off. But then, the lights come on, the hangover hits, and you're left wondering where it all went wrong. The market turns, the profits evaporate, and you're left holding the bag, trying to figure out how you went from hero to zero in the blink of an eye. So buckle up, buttercups, because tonight we're taking a hilarious and horrifying trip down memory lane to revisit some of history's most spectacular market crashes. From the Great Depression to the dot-com bubble, we'll explore the highs and lows of the stock market, and maybe, just maybe, learn a thing or two along the way. 1929, flappers, jazz music, and the unshakable belief that the good times would never end. The Roaring Twenties were in full swing, a decade of prosperity and cultural edge. People were living it up, dancing to the latest jazz tunes, and enjoying the newfound freedoms of the post-war era. It was the Roaring Twenties, and everyone was feeling like a high roller. Parties were extravagant, and the spirit of the age was one of unbridled optimism. People were gambling not just in casinos but in the stock market, convinced that the good times would roll on forever. Stocks? They only went up. The market seemed like a magic money machine, churning out wealth for anyone willing to take a chance. Every day brought new highs, and the newspapers were filled with stories of ordinary people striking it rich. Why, it was practically un-American to think otherwise. The stock market was seen as a symbol of American ingenuity and success. To doubt its endless rise was to doubt the American dream itself. People were mortgaging their homes, borrowing money from their in-laws, and pouring every last penny into the market. It was a time of speculative frenzy, with everyone from bankers to barbers convinced they could make a fortune. Shoeshine boys were giving stock tips, and even your average Joe was convinced he was about to become the next J.P. Morgan. The market was the great equalizer, offering a shot at wealth to anyone with a few dollars to invest.
Then came October 29, 1929, a day that will live in infamy as Black Tuesday. The unthinkable happened. The market, which had been showing signs of instability, finally gave way. The market, which had been teetering on the edge of a cliff for weeks, finally took the plunge. Panic set in as stock prices plummeted, and the once bullish investors scrambled to sell, and by plunge we mean it fell faster than a piano from a skyscraper window. The speed and severity of the crash were unprecedented, leaving everyone in shock. Millions of shares were traded at fire sale prices, but nobody was buying. The market was flooded with sell orders, but there were no buyers to be found. Fortunes were wiped out overnight. People who had been wealthy on paper found themselves penniless, their dreams shattered. People who thought they were set for life were suddenly standing in breadlines. The crash didn't just affect the wealthy, it rippled through the entire economy, leading to widespread unemployment and hardship. It was the ultimate hold my beer and watch this moment in financial history. The hubris of the Roaring Twenties had led to a spectacular downfall, a lesson in the dangers of unchecked speculation.
Black Tuesday, not the best day to check your portfolio. The events of that day would echo through history, a stark reminder that what goes up must come down.
Fast forward a few decades and the year 2000 rolled around. It was a time of great anticipation and excitement. The world was on the brink of a new millennium, and with it came a sense of endless possibilities. The internet was the new Wild West, and everyone was scrambling to stake their claim in this digital gold rush. Entrepreneurs and investors alike were eager to capitalize on the burgeoning online world, convinced that the internet would revolutionize every aspect of life. Companies with more vowels in their names than actual revenue were going public and being valued at billions of dollars. It seemed like every day a new startup was making headlines with its sky-high valuation and promises of untold riches. Investors were throwing money at anything with a .com at the end of it, convinced that they were getting in on the ground floor of the next Microsoft or Amazon. The frenzy was palpable, and the fear of missing out drove many to make hasty investment decisions.
But here's the thing about bubbles, folks. They eventually burst. No matter how high they soar, they can't defy gravity forever. And when the dot-com bubble burst, it wasn't pretty. The crash sent shockwaves through the financial world, leaving a trail of devastation in its wake. Companies that were once worth more than some small countries went belly up faster than you could say bandwidth. Offices emptied out, and dreams of internet fortunes evaporated almost overnight.
Remember Pets.com, the website that sold pet supplies and famously lost a fortune? It became one of the most infamous casualties of the dot-com crash. Their sock puppet mascot became a symbol of the era's excess and the dangers of investing with your heart, or in this case your pet hamster, instead of your head. The mascot, once a quirky marketing tool, now serves as a cautionary tale.
Remember these guys? They were the poster children of the dot-com boom and bust, each with grand visions that ultimately fell short. Yeah, neither does the stock market. The lessons of the dot-com bubble are a stark reminder of the risks inherent in speculative investing and the importance of due diligence. Today, the tech landscape is vastly different, yet the echoes of the past still resonate. Investors are more cautious, and the market is more regulated, but the allure of the next big thing remains as strong as ever. As we look to the future, it's crucial to remember the lessons of the past. Every portfolio needs a screensaver, a reminder to pause and reflect before diving headfirst into the next big trend. Remember the good old days of 2008? Okay, maybe not. The economy was teetering on the brink of collapse thanks to a toxic cocktail of subprime mortgages, Wall Street greed, and enough deregulation to make a laissez-faire economist blush. Banks were handing out mortgages like candy on Halloween, except these weren't your typical prove you have a job and a pulse mortgages. These were subprime mortgages, given to borrowers with shaky credit and even shakier prospects of ever paying the money back.
These subprime mortgages were then bundled together, sliced and diced, and sold off to investors as safe investments. Of course, the people selling these investments conveniently forgot to mention the whole subprime part. When the housing bubble inevitably burst, the entire financial system went into meltdown. Banks collapsed, the stock market tanked, and suddenly everyone was a financial expert, offering their 2 cents on how to fix the mess.
The 2008 financial crisis. Because nothing says economic stability like a vertical line pointing straight down.